Welcome to the 60-Minute CFO podcast, where we dive into the world of business finance and uncover the secrets to running a thriving and profitable business. I'm your host, Tracy Beck, an entrepreneur, author, and your guide to achieving financial fluency in easy-to-digest lessons. This podcast, along with our book, courses, and tools, are designed to help you tackle the challenges that keep small businesses stuck. We'll explore why so many businesses struggle and fail, uncover the missing financial knowledge that could be holding you back, and show you how to take actionable steps toward success. We teach you how to make meaning of your numbers by identifying key relationships and trends so you can analyze your past performance. We learn the key drivers of cash flow because no one likes to run out of cash. And we dive into how to forecast the future so we can set revenue and profit goals and meet them. Whether you're a seasoned business owner or just starting out, you're in the right place. 60-Minute CFO is your source for understanding the numbers, making smarter decisions, and building the business and life you've always envisioned. Let's get started. Revenue is up, but profit is down. Sound familiar? Let's talk about why focusing on the wrong financial numbers could cost you everything and how to shift your focus to what really matters. Today, we're diving into a common but dangerous trap, focusing on the wrong financial metrics. Many business owners zero in on vanity metrics like revenue or even social media followers. These can look impressive, but don't necessarily reflect your business's financial health. The real indicators of success are often hiding in plain sight, and I'm here to help you find them. Let's talk about the blind spots that trip up even seasoned entrepreneurs. Focusing on amount of profit instead of profit margin. This is a big one. Dollars are exciting and easy to grasp. We deal in them every day, and it's what we see in our bank accounts. However, they can be misleading and don't always give us a good idea of how well we are doing. Here is my favorite example. Would you say that a $5 million profit is good? I'm betting you're nodding your head right now and saying, hell yeah, Tracy, that'd be great. But what if I told you that the revenue for your business was $5 billion? That would mean that for all of our hard work, we made 0.1% profit margin. That is about break even. And I think we'd hope to keep a whole lot more of that $5 billion that we made. And I'm guessing that was a lot of work as well. So here's the takeaway. It's not about the numbers on their own. It's about creating a relationship or a ratio with other numbers that gives context, meaning, and tells a story. Here's another common misconception. We focus on the wrong level of profitability. If we have a profitability problem, we usually try to grow our way out of it with increasing revenue. But this can be very hard if we don't know which level of profitability is broken. And there are three: gross, operating, and net profits. Gross profits are what we have left after we pay our cost of goods or cost of sales. Operating profits are what we have left after we then pay our operating expenses like managers, utilities, rent, paper, pencils. You get the idea. Net profits are what we have left after any other non-operating expenses are accounted for. And these are usually small or somewhat inconsequential. When we divide each of these by revenue, we get our gross, operating, and net profit margins, not dollars, margins. So we relate the dollars back to revenue to get it expressed as a percentage, and that is our margin. Most owners focus on the bottom line or net profit, and if it's not enough, they focus on increasing the top line, which is revenue. But this can be crazy making because we don't know why the margins aren't high enough. Instead, we should go through each level and ensure that we are making the right amount of profit. For example, many businesses aim for a 50% gross profit margin, a 30% operating profit margin, and 20% net. This varies by industry. And if you don't know your industry averages, I urge you to become a part of our community and find yours out. Once we gain clarity on where we are not meeting the mark, we can have laser focus on fixing the issue at that level. It could be mismanaged labor, contracts with vendors that are too high, too lavish of office spaces, too many administrative employees, or perhaps we aren't charging enough. But the answer is in the 3 levels. So, focusing on the top and bottom lines alone don't give us the full story, and we must read between the lines. Here is another common thing that business owners do: confusing growth with profitability. Growth feels like progress, but it's expensive. It requires hiring more staff, buying inventory, or ramping up marketing to increase the revenue, but that can also eat into our profits. If you're not careful, growth can outpace your ability to fund it. For example, a tech startup doubles its revenue in a year by adding new customers. However, they had to hire more developers and spend heavily on customer acquisition, leaving them with a negative profit margin. Here's the takeaway: growth for growth's sake can sink your business if you're not watching profitability. Additionally, we must be able to predict what growth will do to our business, which we will get into in more detail later. It's one of my favorite topics. So here's the solution. How do you ensure you're focusing on the right metrics? Well, we have to track all 3 levels of profitability. Revenue and net profits do not tell the full story, so know your gross, operating, and net profit margins. Here is a tip. Use your accounting software to calculate this monthly. Divide net profit by revenue and multiply that times 100. If you choose the checkbox, add percentage of revenue to the income statement, it will do this for you. This is available in QuickBooks and Xero and likely in your report as well, if you don't use those 2 programs. Review your break-even point. Your break-even point is the minimum revenue you need to cover expenses. Knowing this number helps you set realistic sales goals and avoid unprofitable growth. Let me say that again. If we know our break-even point, we can avoid unprofitable growth. Here's an actionable tip. Calculate this annually and revisit it if your costs change significantly. You can use our spreadsheets at 60 Minute CFO, our business mastery spreadsheet, to calculate your break-even revenue because there's a little bit of a formula to it. So let's look at this in the real world. Let's meet Jenny. She's the owner of a small bakery. Her revenue had been climbing steadily, hitting $300,000 in sales last year. She was feeling really great about this growth until she realized her profits were shrinking. Sarah's expenses, including her rising ingredient costs and extra staff hours, had ballooned. On top of that, her cash flow was, shocker, tight because customers had often paid late. Here's what Sarah did. She calculated her net profit margin and found it had dropped to 8%. She reviewed her industry averages and her new goal became 15%. So she reevaluated her pricing and cut unnecessary expenses. Now, if you're thinking, how did Jenny get to the 15%? She was able to look into what her industry averages were, which is something that we can pull for you at 60 Minute CFO. And if you otherwise don't have access to that, or if they aren't available for your industry, you can use peers that you might know in the industry. You could call someone across the country who isn't one of your direct competitors, ask them what their net profits are, tap into your banker who might know, or otherwise look at your own trends and set a goal for yourself to meet based off your past performance. So then once she knew her goal, she started monitoring her cash flow weekly, which helped her adjust payment terms with suppliers and offer small discounts for early customer payments. Finally, she redefined her break-even point to reflect her higher costs. This helped her set sales goals that were realistic and profitable. The key word being profitable. So today, Sarah's Bakery is thriving with a 20% net profit margin. So she met and she beat her goal. She has steady cash flow, and best of all, she has clear and reasonable financial goals. So here is your call to action for this episode. Your numbers tell a story. Make sure you're reading the right chapters. This week, carve out 15 minutes to look at all 3 levels of profitability. You're going to pull up your income statement or your profit and loss report if you're in QuickBooks. Are they moving in the right direction? If not, it's time to dig deeper. Remember, the goal isn't just more revenue. That's a vanity metric. It's a financially strong, sustainable business. Those are the real metrics. Don't let misunderstood metrics steer you off course. Let's focus on what really matters. Until next time, take care of your numbers and they'll take care of you. Thank you for tuning into the 60-Minute CFO podcast. I hope today's episode gave you fresh insights and practical steps to better understand your numbers and take control of your financial future. If you enjoyed the show, don't forget to subscribe, leave a review, and share it with other business owners who could benefit. Your support helps us reach more people on their journey to financial fluency. To dive deeper into what we talked about today, visit 60minutecfo.com, where you will find more tools, resources, and ways to connect with me, Tracy Beck. You can join our community, download our free resources, and sign up for live and recorded courses. Until next time, remember, understanding business finance is a journey, not a destination. Create 60-minute habits of dedicating time to understanding your numbers, and before you know it, you will have built the profitable business and life you've always dreamed of. See you in the next episode. And this is important work for you to do because no one will care as much about your business and finances as you do.